Okay, well, this is going to be a series of 5 webinars, and it's going to go through factor design, and then we're going to talk about how to design ranking systems and universes, how to use screens and simulations, principles of backtesting, and in the 5th webinar, I'll be talking about how to actually implement a strategy and how to trade it. So it's going to really cover a lot of stuff. The factor design, I think, is the most important of the 5, because without good factor design, you really don't have any way of beating the market. What are factors? A factor is simply a reason to buy a stock. Is it cheap? Does the company have a brilliant CEO? Is the industry poised to make a comeback? Is its market share increasing? Those are all factors. Those are all the things that everyone who buys stocks thinks about when they decide whether or not to buy the stock. So that's what a factor is. Now, only some factors are quantifiable and others are qualitative. So value is quantifiable. You can assign a number to a stock's PE, or its price to sales ratio. Whether or not a company has a brilliant CEO, that's a qualitative judgment, and that's not something that we can use to create a fundamentals-based strategy, because it's purely subjective. And only some quantifiable factors have readily available data. For example, you can get the book value of a company from its financial statements. But that's just the book value. That's not the market value of its fixed assets. If you want to know the market value of its fixed assets, you'd have to go to a lot of different sources, and you'd have to really dig in deep into that particular company and figure out the market value of each of its fixed assets. That's not something that's provided in the financial statements. So there are some factors that have readily available data. And those are the factors that we can use in portfolio 1, 2, 3. The whole purpose of multi-factor ranking is to take as many factors into consideration at once. In other words, to create a system that evaluates every stock from a large number of different angles. Now, the analogy I like to use here is the used car analogy, and this is something I'm going to be referring to throughout the 5 webinars I'm going to be giving, because I really view that analogy as the most appropriate to buying and selling stocks. And probably most of you have, at one point or another, bought a used car. And I think that it's an appropriate analogy to buying and selling stocks, because this is something of value that you're buying on a secondary market. It's not usually, unless you're buying through an IPO or a direct listing, you're not buying a stock directly from the company. And the same thing's true when you're buying a used car. And when you're buying a used car, you want to take into account its price, its mileage, what the person who last owned it, how it was driven. You want to look at what other people are paying for the similar car. You want to look under the hood and make sure everything's working. You want to give it a test drive. These are all things that you can compare in one way or another to buying a stock. Now, by the way, if you have any questions as I'm going through this, please feel free to chat me. I think that's fine. So what makes for a good factor? First of all, does it work? Does it make sense? From an accounting standpoint, for example, the price you pay for a stock in relationship to its earnings or sales, that's something that makes sense. And the price you pay for a stock in relationship to its inventory doesn't really make sense, because companies are not worth more if they add more to their inventory. Actually, they can be functioning better if they reduce their inventory. So factors have to make good accounting sense. From a behavioral standpoint, let's say you had a factor that favors stocks with huge increases in volume and a concomitant increase in price. That would be an example of what behavioral psychologists call herding. It's basically buying what everyone else is buying. And that is a foolhardy thing to do. Any behavioral economist will tell you that. It means buying when the stock is priced the highest and selling it when everybody else is selling it when the price is the lowest. It's a terrible way to invest. So you want to see whether your factors make sense from an accounting standpoint and from a behavioral standpoint, and then you want to see whether it actually makes a difference, whether it distinguishes some companies from others in a way that'll increase your returns. And to answer that question, you need to employ back testing, which I will get to later. The other big question is, does it have an edge, or has it already been arbitraged to death? And very common factors may not work as well as uncommon ones. Let me just explain what arbitrage is. Let's take book value to market cap. This is a very, very common factor. It was identified in the 1990s as one of the 3 most essential factors by a couple of academics who won the Nobel Prize. And so everyone started using that factor to define value. They weren't looking so much at PE, they weren't looking at price to sales or price to research or EBITDA to EV. They were looking at book value to market cap. And that's how they built these index funds, particularly the Russell funds. Their growth and value funds are based on book value to market cap. So once everyone started using this factor to define value, stocks with high book to market cap ratios had very clear reasons to be cheap. Maybe they were being mismanaged. Maybe they were low growth companies. Maybe they were in industries that just were failing. There was very little mispricing left because everybody was using this ratio. That's the nature of arbitrage. Once everyone is using a factor, it stops working. And this is not a hard and fast rule. It's possible that price to book value will come back. It's, you know, maybe people will be, I thought that price to sales was basically arbitraged away, but it's made a big comeback recently. So it's hard to tell when a factor has been completely arbitraged, but it's something you want to think about when you're thinking about what makes for a good factor. A factor that nobody is using, but that actually works, is the kind of factor that will give you an edge. So factors must be viewed in combination. They can't be viewed alone. We will be talking mostly in this webinar about viewing them alone, but factors can be useless on their own, but can amplify other factors. A good example is size factors. There's been a lot of studies that say that small caps have outperformed large caps in the long run, but I don't believe them. Small caps and large caps are 2 different kinds of companies, and I don't think that it's a useful factor to use on its own. But however, size factors can really, really amplify other factors. If you design any multi-factor ranking system and then add a size factor in there, like low market cap or low volume or low sales, low assets, you'll find that the performance of that multi-factor ranking system, the difference between the stocks that rank highly and the stocks that rank low, is going to be amplified. So that's a factor that's an amplification factor. Size factors are amplification factors. There are other factors that can work that way too. Now, factors can work for some stocks and not for others. For example, inventory reduction is a good factor if you're looking at retail companies, but it's totally useless if you're looking at software. And then factors might work one way for stocks with certain characteristics or in certain industries, and the opposite way for stocks and with other characteristics or in other industries. And a good example there is debt. Debt is a factor that will work against you in most industries, but it'll work in your favor if you're looking at banks. Banks really need to have debt. That's how they make money. A bank which doesn't have any debt is not going to make any money. So the factors have to be thought about in a holistic way. How is it going to combine with other factors, and how is it going to apply to different kinds of stocks? Now, factors, there are factors that might not work, and then there are essential factors. And it's important to think of factors and not as a menu, like an a la carte menu, like you'd get in a restaurant. Oh, I'm going to get a little of this and a little of this, but I'm not going to choose everything on the menu. That would be insane. That's not the way to think of factors, because they're kind of, when people talk about statistical analysis, they talk about type 1 errors and type 2 errors, and that's kind of a forbidding language, but let me just quickly explain. A type 2 error is the non-inclusion of an essential factor. The type 1 error is an inclusion of a flawed or non-essential or a harmful factor. So let's go back to the used car analogy. Let's say you were evaluating your used car and you forgot to look at its mileage. That would be a type 2 error, and that would be a lot worse than if you remembered to check whether the side mirrors can be easily adjusted from inside the car. That's a kind of type 1 error. So it's very important to try to think of all the things that could have a major impact on a stock's return, and try to formulate. I don't know. Can you still hear me? I'm getting weird Zoom messages here. Okay. For some reason, Zoom is telling me weird things. Okay. So yeah, try to think of everything you want to look at in a stock when you're designing factors. Now, there are 7 types of factors we're going to talk about here. Fundamental factors are value factors, growth factors, and quality factors. There are technical factors, sentiment factors, there are stability and low volatility factors, and size factors. Now, technically, stability factors are a subset of quality factors, but I separated them out because I think they go very well with low volatility. Fundamental factors. Fundamental factors require at least a basic understanding of financial statements. Now, I'm not going to go into depth into a basic understanding of financial statements. That would be a subject of another like 10-part webinar, I guess. It's really something you have to know before you design a fundamental-based ranking system or any kind of fundamental-based investing. And it's not that hard to learn. I'm giving you a few suggestions here in the PowerPoint. How Finance Works here to Decide is a great little book. It's got wonderful questions at the end of each chapter. There's this one part where you have to try to figure out what company he's talking about just from the looking at the figures in the financial statements, and that's really a cool exercise, a very informative exercise. There are free courses from the Corporate Finance Institute. I have not taken these courses, but they look really, really good to me. In general, the Corporate Finance Institute has wonderful stuff on their websites, lots of courses, and it's a great resource. Now, the thing about fundamental factors is that in a way, they are impervious to statistics. In most sciences and lots of sports too, you can work with completely objective statistics such as height, weight, distance. In sports, you can look at, in basketball, you can look at field goal percentage, rebound percentage, and number of points scored per game, in addition to height and weight and age. All of those are statistically fine. I mean, there's just no question. They are what they are. They are facts. In a financial statement, that's not true. Every single number in a financial statement is an interpretation by the company's accountants and officers. It's all fuzzy, and you have to keep that in mind if you want to understand investing using financial statements. This is not hard science. It is fuzzy math. So, getting that out of the way, let's go to value factors. These are factors that compare something about the company with its per share price, its market cap, or its enterprise value. And the something about a company has to match the comparison. So if you're looking at price, if you're comparing price, you have to use per share values. You can't just use a company's sales. You have to use its sales per share. If you're comparing a market cap, you have to use values that are adjusted for the equity portion of the firm. Now, remember that most firms have debt. And if you're looking at operating income, that is good to compare to the entire firm. But net income is good to compare to market cap. Why? Because you're deducting interest expense from operating income when you get to net income. And interest expense is applicable to the debt part of the company. So you want to use figures that are adjusted for the equity portion of the firm. So operating income to market cap is not an acceptable value ratio. And net income to enterprise value is also not an acceptable value ratio because enterprise value includes, it takes care of the debt of the company, but but net income deducts the interest expense. You want to add back the interest expense if you're going to compare it to enterprise value. If you go to the Corporate Finance Institute, you can find more about this, but there's basically certain things that you have to match up, whether you're comparing to market cap or enterprise value. There are a few things that it's okay to do with both. Sales really should be compared to enterprise value, but everybody uses it with market cap, and it's not that big a deal. Now, many factors should be compared to firms in the same sector or the same industry, and that is a subjective decision on your part. There are good reasons to compare PE to other companies in the same industry, but there are also good reasons to compare it to the universe as a whole. I prefer to, with value factors, I prefer to go with industry comparisons or sector comparisons, particularly when they are compared to market cap, because companies have very different capital structures depending on their industry or sector. With enterprise value, I'm more flexible, and I usually use I usually use the entire universe for those comparisons. Now, there are two ways to structure value ratios. You can put the size value, the price, market cap, or enterprise value as the denominator, or you can use it as the numerator. So price to earnings uses the price as a numerator and earnings as the denominator, and earnings yield does the reverse. I prefer to do the yield version. To me, it makes more intuitive sense because I'm seeing what I can get out of the company. I'm using higher values better, and I don't have to worry about negative values. When you are using PE or price to sale, well, not price to sales, but if you're using PE or price to free cash flow, you have to worry about negative values. And for example, what do you do if you're using EV to EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. It's an abbreviation you'll come across a lot. What do you do if both the enterprise value and the EBITDA are negative? Then you end up with a positive EV to EBITDA, which makes no sense if you're using, if some of the things have a negative EBITDA but positive EV, or negative EV and positive EBITDA. You have to think this all through. The solution here, in this case, is to use EBITDA divided by EV. Allow negative numbers in EBITDA. With EV, take any negative number and convert it to a small positive number. The reason for this is having negative earnings is not a good thing. You don't want companies to rank highly because they have negative earnings. But having negative EV means that your company is full of cash, has tons and tons of cash. And that's not a bad thing. So, converting a negative EBITDA to a small, a negative EV to a small positive EV, you can do that by simply writing the formula as follows. You can do EBITDA divided by the maximum of 2 million and the enterprise value, or 30 million and the enterprise value. So that anything with an enterprise value less than a certain amount is the same, and you just and it's not so this isn't a precise way of looking at things, but it solves a problem that you would have. But it's also important not to use EV-based formulas for banks and insurance companies, since debt means something entirely different for those firms. Growth factors are factors that look at the year-by-year or quarter-by-quarter change in the fundamental part of a value factor, like earnings or sales or dividends or EBITDA, that kind of thing. For example, the 5-year change in asset turnover would not be classified as a growth factor. The 5-year change in sales is classified as a growth factor. So I don't classify ratio changes as growth factors, and growth factors also should not include price data. I have a comment in chat. Jacob Rothman says negative EV means that the company has net cash in excess of its market cap. I would think these are extremely rare these days. I can't remember ever seeing a negative EV company. Prudential Insurance was a negative EV company pretty recently. I know I said that you shouldn't include insurance companies, but that's one that I remember being negative EV. And then there's some other companies that are sitting on huge piles of cash. So I don't know, I found quite a few negative EV companies when I was researching it a few years back. So the formula for growth is present value minus past value divided by the absolute value of past value. Now, the more intuitive formula for growth would simply be present value divided by past value minus 1. But that formula doesn't allow for negative values. So when a value factor like earnings or free cash flow can be negative, growth can get really weird. I mean, the growth of a company that had negative 2 cents in earnings per share last year and has 2 cents in earnings per share this year would be 2 minus negative 2, which is 4, divided by the absolute value of negative 2, which is 2. So that's 200%. And that's just kind of weird when you think about it. But that's the only way to do it. I've tried all sorts of other ways to deal with growth with negative numbers, and nothing else really works. Now, not all growth is good. Would you rather invest in a company with a steady 15% earnings per share growth over each of the last 5 years, or a company with 400% EPS growth over the last year? One is sustainable, the other is not. So because not all growth is good, you might have to adjust growth factors, favoring companies with middling growth or favoring companies with good but not excessive growth. And that gets very hard to code. You can't just use, our built-in growth factors for that. You have to do things that are very complicated. I'll just give you 3 examples, three things that you could do if you wanted. One, the best way, but very complicated, is to create a parabolic curve that with the open end pointing downward, and get the formula for that parabolic curve. And that's the ideal way, because then you've assigned every growth rate to a point on that curve, and everything's cool. But it's complicated and it takes a lot of practice. Another way is to rank with low or better on the difference between the growth rate and the absolute value of the rate that you want to rank the highest. For example, the absolute value of EPS growth minus 20%. That'll get you the company. So companies with 20% EPS growth will get 0, and that'll be the highest. Companies with 15 or 25% will be next. Companies with 10 or 30% will be next, and so on. Or you could assign points to different growth rates and rank them. For example, you could say companies with a growth rate between 20 and 30% get 10 points. Companies with a growth rate of -30 get 0 points, and companies with a growth rate of 200% get 2 points. You could just do something like that, cobble things together. So those are some suggestions, but it gets complicated. Quality factors are factors that are based on financial statements that are neither value nor growth factors. And there's a huge variety of such factors, and really possibilities are practically limitless. Almost all of them are financial ratios. Examples include asset turnover, return on equity, gross margin. Asset turnover, by the way, is sales divided by assets. Return on equity is net income divided by common equity, and gross margin is gross profit divided by sales. You could also look at net operating assets to total assets, operating accruals to net income, operating cash flow to sales, capital expenditures to gross plant, debt to EBITDA. All sorts of things can be classified as financial ratios. Now, I had a chat here asking if I intend to say more about mapping growth to a parabola. And I had not intended on saying anything more about that. But if you map, let's say, I can add a few more words. Let's say you have back-tested growth and you find that let's say you find that companies with 20% growth deliver an 11% return, companies with 0 growth deliver a 5% return, and companies with 100% growth deliver a negative 2% return. You can plug those 3 numbers into Excel and get a formula using the charting capacity of Excel for a parabola that will link those 3 points. And then you can use that function as the basis for your factor, just using X as the growth rate. I hope that makes some sense. Now, going back to these ratios, quality factors can include factors that depend on change from year to year. So, for example, the change in inventory is a quality factor. The change in accruals could be a quality factor. You could do things like that. Or they could be the change in, or they could be the change in a ratio from year to year. Those ratios I just mentioned, like the change in asset turnover and the change in return on assets from one period to another, could be quality factors. And now, when you're doing changes in ratios, you have a choice. You can either do a difference or a quotient. For example, you could take ROA from this year minus ROA from last year, and that could be your factor. Or you could do ROA of this year divided by ROA from last year. In that case, you have to really figure out what you're going to do about negative numbers, and you might want to use the growth formula that I talked about earlier to do that. But so that's why when I'm doing the difference in a ratio from one year to another, I usually use subtraction. Now, about half of the factors that I use are quality factors, and that is something that you really want to look at carefully. I think that quality factors really can make a huge difference in a multi-factor model. But again, you're going to have to do a lot of reading to come up with good quality factors. You can, or take courses, or read academic articles, look at the forum, look at the quality factors that we use in our core ranking systems. There are a lot of places you can go to look at to get those. Sentiment factors. These are mostly based on changes in analyst estimations and recommendations, but you can also look at the plain vanilla recommendations as well. I have a chat comment. Seems that quality factors are not particularly powerful on their own, but are excellent at amplifying other factors. I would say that because of the used car example I gave about forgetting to look at the mileage, if you're not using quality factors, I think you have problems. But if you're using only quality factors, you're also going to have problems. You have to look at the price. You have to look at growth. You have to look at a few other things about a company. If you're only looking at quality, it's problematic. But at the same time, if you're not looking at quality, that's problematic too. Now, other sentiment factors are ownership factors, buying, selling, and percentage holdings by institutions and by insiders. And I'll give you a little tip here. Insider buying is much more valuable than insider selling, which is often meaningless. People have all sorts of reasons to sell their shares, but there's only one good reason to buy shares in the company that you're in. It's because you expect it to do well. Now, short interest can also be a valuable factor. It's a little hard to get, but we offer it portfolio 1, 2, 3. So these are all good factors to take into account. Technical factors are a little more complicated. Sentiment factors are pretty straightforward, but technical factors, which are factors based on price and volume, are a little tricky. Now, they come in 6 general categories. Charting, and we're not going to cover charting because it doesn't work. There have been a lot of academic studies, and they have concluded that charting is it's kind of like astrology. And B, it's impossible to automate them with portfolio 1, 2, 3. Mean reversion is a second factor. Momentum and trend following are basically very similar. That's a third. Post-earnings announcement drift is not usually considered a technical factor, but it is. And there are volume-based technicals and volatility-based technicals. The volatility-based technicals we will leave for a discussion when we cover low volatility and stability. Now, the reason you have to approach technical factors with great care is because they can be deceptive, and because the logical explanations for technical phenomena are often unclear or totally absent. Other factors can usually be relatively easily explained, but technical factors work in very mysterious ways. Let's talk about mean reversion, which is one of the factors that really can be explained. In probability, the law of regression to the mean states that when measuring the distance of a variable from the mean of those variables, it will be more likely to be closer to the mean in the future than farther from the mean. And this depends on the imperfect correlation of depth. Let me give you an example. If tall parents always produce taller children and short parents always produce shorter children, there would be perfect correlation and there would be no mean regression. But because there's an imperfect correlation between height of parents and their children, 2 7'6" parents are not very likely to produce 7'6" children, and 2 4.5-foot parents are not very likely to produce 4.5-foot children. So when applied to stock prices, this law becomes the principle of mean reversion, which says that a stock whose price has fallen or risen relative to the market is more likely to reverse course than to keep going in the same direction. Now, there are very important exceptions to mean reversion, and they are 3. The the two most important ones are momentum and post-earnings announcement drift, which I will be getting to in a minute. Mean reversion works best over periods shorter than 3 months and longer than 2 years. And that's because those exceptions really work in the middle region of those. Momentum is the phenomenon of a stock's price continuing to drift farther and farther from the mean in contradiction to mean reversion. And this typically happens over periods of 6 to 12 months. And now I'm going to explain why. Momentum is a reflection of a company's perceived performance and the slowness of the process of arbitrage. So let's take two companies, A and B. A looks like it's growing and it's becoming safer and healthier. B looks like a company in decline and distress. A's price has recently risen because of this, and B's price has recently fallen. Now, as time goes on, is it more likely that there's going to be positive news about company A or about company B? Clearly, it's going to be more likely that there's going to be positive news about company A. So A is more likely to have good things happen to it, and that is going to increase its price. B is more likely to have bad things happen to it, and its price is going to continue to fall. And this phenomenon is so powerful over the 6 to 12 month time period that it overcomes the natural tendency of mean reversion. However, as things get longer and longer, over 2 and 3 years, the situations that the price gets basically adjusted to what the company is actually worth, and there's less mispricing to be involved, and there's less, and the arbitrage will have been completed, and then things will go back to the normal process, which is mean reversion. Now, when designing momentum factors, I'd like to give you some advice. Don't take into account the most recent month. In other words, to measure 12-month momentum, use the price a month ago divided by the price 13 months ago. If you're using 6 month momentum, use the price 1 month ago divided by the price 7 months ago. This allows you to buy on the dip, which is a really good way to buy stocks, especially if you use it in conjunction with value or mean reversion factors. If you don't do that, what might happen is the company's price might go up, and it'll then rank higher, and you'll be more likely to buy it when it's rising. And that may not be good for your wallet. Now, some people believe that momentum can predominate over short time periods. This is the whole, a lot of technical analysis is based on this idea. And these people are called trend followers, and they design complicated factors that take advantage of this belief. And I am not a trend follower, and I do not recommend trend following or factors that take advantage of very short-term momentum, because it contradicts the rule of regression to the mean. I don't think that they work very well. I need to talk about post-earnings announcement drift before we go to the next slide. It's been observed that a significant relative price movement following an earnings announcement will result in a continuation of that movement rather than a regression to the mean. And this is due to the infrequency of rebalancing by some money managers. If a money manager only rebalances monthly or quarterly, it'll take some time for the good or bad information imparted by the earnings announcement to affect the money manager's portfolio. Now, this could be applied to other news about a company, which is another reason why sometimes short-term momentum works, sometimes mean reversion doesn't. It's the way news is arbitraged by the market is a little slow. There can be lags, though the instantaneity of everything these days means that perhaps this doesn't work as well as it used to. Now, volume-based technical factors, I've observed that a large increase in volume tends to result in a subsequent increase in the price, whether that increase in volume is coincident with a price increase or a price decrease. And the mechanics of how this works are unclear to me. The phenomena does seem real, but maybe it's limited to microcaps and small caps. I don't really know. This is a subject for further investigation by you or by me. Someone should look into it. Stability factors. These are all about avoiding extremes and huge variations. They're a subset of quality factors, and they look at the stability of certain fundamentals, and they can take a wide variety of forms. Comparing periods, for example, you can look at the standard deviation of a measure over a number of periods divided by its average, with lower results being better. For example, you could take the standard deviation of quarterly sales divided by the average of quarterly sales over the last 5 years. That's a really good factor to use. It really helps you avoid companies with huge differences in sales, which can distort all the other numbers that you're looking at. You could do something very similar by taking the absolute differences between the periods and divide by the sum of the values, again, with lower results being better. So you would take the absolute difference between this quarter's sales and last quarter's sales, add that to the absolute difference between last quarter and the quarter before, and so on, going back however long you want, and then you would divide it by the sum of all the quarters. It's a very valuable measure too. The other totally different way to look at stability is just to compare your stock to other stocks in terms of a change, a period to period change. So, for example, you could say that the median value of the annual change in sales, the closer that is to, so the closer your annual change in sales of your company is to the median value of all companies, or all companies in that industry, or all companies in that sector, the better. And I do that in particular with assets. If I'm looking at a period-to-period change in assets, I want it to be pretty comparable to what other companies are doing, rather than having it be really extreme. So the stability factors are most useful to eliminate stocks rather than to choose stocks. So just keep that in mind. Volatility factors are very closely related to stability factors. Stocks with low price volatility are going to be stocks with stable fundamentals, and vice versa. Now, stocks with low price volatility tend to outperform stocks with high price volatility. The same may be true with volume volatility, but I'm not really sure. This only applies to certain markets, market conditions. For example, from the second quarter of 2020 to the first quarter of 2021, this was not true at all. Stocks with high price volatility outperformed stocks with low price volatility by leaps and bounds. So a lot of this depends on market conditions. Now, stocks with low share turnover tend to have lower betas and thus higher alphas, which also leads to high performance. Now, share turnover is simply the volume traded divided by the number of shares available. Now, stocks with low beta tend to have high alpha and vice versa. This is a total contradiction of the capital asset pricing model, but it's the truth. And it's been known since the early 1970s. And very few people realize that this is actually a mathematical inevitability. I think I'm the only one who discovered this. I published a proof of it. It's a mathematical inevitability when the market is more likely to produce positive than negative returns. In those cases, then lower alpha is likely to correspond with high beta and vice versa. Someone asked if I have a link to the paper, and you can find it if you search under my name and high beta, low alpha, and seeking alpha, or investigations, which is the name of my blog. Or I could email you all the link later. Now, Share turnover is a more reliable and more forward-looking measure than beta, so I would suggest that you use that because it depends on very recent data, while beta needs to be examined over years. And it's difficult to calculate with precision, and it can vary wildly from one time period to another. And I have another paper about share turnover, which you can probably find on Seeking Alpha or Investigations if you Google share turnover in my name and those sites. Size factors don't work on their own. As I said earlier, they should be used only if you want to enhance the effectiveness of other factors, like going for small stocks, or if you want to eliminate small stocks without a hard limit and go for large stocks. There's really no right or wrong direction for the arrow for these factors. Size factors could be related to market cap, daily dollar volume, assets, employees, or anything else that indicates size. Recently, I've been reading Peter Lynch, and he uses as his size factors the number of analysts that are covering the stock, or the lower the better, and a number of shares of the stock that are held by institutions, the lower the better. So there's all sorts of ways you can look at size. Now we'll go to assessing factor performance. There are 4 ways to do that: using buckets, using quantile equity curves, using the DataMiner, and using screens and simulations. Now here I'm talking just about portfolio 123's ways of assessing factor performance. You may be able to assess factor performance differently on other websites. I'm going to show you something about bucket performance. I'm going to go to a ranking system here. Let's look at the core sentiment ranking system. And I'm going to do a performance test. I'm going to do 10 years every 4 weeks. I'm going to use let's use the Russell 3000 here, and let's use 10 buckets, and I'll run that. Basically, this bucket performance thing divides stocks into quantiles. Here we have 10 quantiles. They're called deciles if there are 10 of them, ventiles if there are 20, terciles if there are 3. And they are, you see the performance according to how they rank on the factor. So the stocks in this top bucket out of 10 rank very highly on the sentiment ranking system, and the stocks in this 10th bucket here rank very low. This is a kind of dummy bucket for the S&P 500, which is a little confusing in this, but you'll get used to it. And so these are the annualized returns for each quantile according to the rebalance frequency. Now, I have some tips here. Always check both the 10-year and the max in the settings. Here I did, the period was 10 years, but I would also suggest using the max as well, or 15-year or something else, because if you use only the max, you may get misleading numbers. If you use only 10 years, you might get misleading numbers. It's just good to check them both. If the rebalance frequency is greater than 4 weeks, I would try to choose a different starting date as well. Just vary your starting dates, because you'll get different results based on different starting dates with infrequent rebalance. Never use all fundamentals as your universe. If you look at the settings here, the default universe is all fundamentals, but that is a terrible universe to use, because you're going to get some stocks that are only selling for 2 cents. And if they go up to 3 cents, then they're going to have a 50% return. And if they go up to 5 cents, they'll have a 150% return, and it's going to skew all your buckets. If your factor excludes certain stocks or returns a large number of NAs, create a universe that excludes those stocks or NA stocks before doing a quick performance test. For example, if I were to look at, say, all fundamentals Canada, and no, let's see, that's not a good one. Oh, no OTC exchange here, and I looked at 20 buckets, I would probably get an empty bucket, because There are quite a few stocks that don't have any sentiment ratings at all. Well, actually, I don't get an empty bucket, but you know what I mean. So you might want to create a universe that excludes stocks that are NA. I would not use more than 20 buckets. I mean, some people like to run these charts with 100 buckets and see what happens and see what the top bucket will do. And that's just kind of, I mean, this is just crazy. You're not going to get 34% out of sample returns by using the sentiment, you know, on a bunch of not over-the-counter stocks. I just think that's misleading. I would go with 20 buckets at the most. And remember one other thing, that the minimum price is applied after the ranking. If you go to this, let's go back to the settings here. You scroll down, there's a minimum price here. That's applied after the ranking. So in some cases, you might get empty buckets, and they might actually show returns even though they're empty. It's better if you're worried about this kind of thing. Most of the time you don't have to worry about it. But let's say that you're ranking mining stocks, and you're including all the over-the-counter mining companies, most of which are Canadian, and most of which have prices between 25 cents and $1.50. I mean, these are really, the mining stocks for some reason tend to be very low priced. And you set a $3 limit, you're going to get some empty buckets because so many of these stocks sell for less than $3. So you might want to create a universe that has your price limit in it before you do the ranking. Now, quantile equity curves are found by clicking on the Performance tab instead of the Annualized Returns tab. So let's go back to, say, 5 buckets, and we'll look at this. We'll run it on the Performance tab, and we'll get this result here. As you can see, you get actual quantile equity curves for each in this case, quintiles. This purple one is the stocks that rank the highest, and the darker blue one is the stocks that rank the lowest. And you can download this data here, and then you get an Excel file with all the month-by-month values for these equity curves, and then you can use all sorts of sophisticated analysis to analyze the equity curve. So you can see when the factor outperformed and how frequently. You can see that a factor worked in 2005 and it didn't work in 2006. You can measure the alpha of the top bucket compared to the middle bucket, or all the buckets combined, or the benchmark. You could graph the top minus the bottom bucket over time. This is just a really handy thing to do if you want to do some really deep statistical analysis on your ranking factors or your ranking systems. Now, let's go to the next slide, which is about using the DataMiner. And this is a handy tool that we just rolled out last year. And you can read about it if you go to research and click on API and DataMiner. There's some really good knowledge base articles about how to use it. Oh, someone asked how I got to the ranking buckets. So that's kind of I guess a more basic thing here. Maybe I went too fast, but if you go to the ranking system and then you go to performance and then you go to historical performance by then you get this screen and you click annualized returns. That's how you get to the ranking buckets, and the number of rank buckets is right here in this box here. Okay. The DataMiner The rank performance function of the DataMiner gives you not only the annualized return for each bucket, but also a huge variety of other information. You can see that you get, I really like this one, the percent of periods that the strategy outperforms for each of the 5 buckets, or you can use 10 buckets, whatever. And you also get the average return in up markets, the excess return in down markets, the Sharpe, Sortino, standard deviation, maximum drawdown, beta, alpha, the average number of positions, which you would expect to be equal, but because this particular one was used after the ranking price removal of stocks that were selling for less than $3, you get slightly uneven buckets. So this is a very nice tool that gives you more information than you could possibly want about factor performance. Lastly, I use screens and simulations a lot to evaluate factor performance. So especially if you're interested in performance for long holding periods. If you are testing performance for a holding period of a year and you're using the bucket test, and over the last 10 years, you're only going to have 10 dates on which you are evaluating that factor. And that may not be enough. That's a pretty small number of dates. But if you use the rolling back test in a screen or a simulation, then you can look at all these different starting dates and see how your factors performed. Of course, you can only look at one bucket at a time, so it's much more labor intensive to do it that way. But there are other instances in which simulations are better than using rank performance. So if you're using variable position sizing, then we have simulations that can be done in simulations, and that's going to be something I'll be talking about in the third webinar.
Yeah.
And if you are using rank-based buy and sell rules, then you can use those in the simulation. If you're going long or short on an unequal basis with realistic margins and transaction costs, then obviously you can't really do that just by using buckets. Or if you're using different universes for the long and short ends of a factor. For example, you can't really short microcaps. So you want to look at a ranking system that's good for both long and short, but you want to short the factors on a different universe than the longs, then you'll have to do that with simulations and books to evaluate the performance. So the next thing we're going to cover in the series, I'm going to talk about designing universes and ranking systems, and that'll be in 2 weeks. After that, I'll be talking about simulation design, then the principles of backtesting, and finally, we'll be talking about strategy. So does anyone have any questions about this? Okay, someone wants to get to the ranking buckets again. Let's go back there. Now, what is your specific question about this? I could run this again if you'd like. We have a ranking system here, and I'm going to run it over the last 10 years. It's going to rebalance every 4 weeks. And I can run it, and I will get 5 buckets. 1, 2, 3, 4, 5, plus the S&P 500. So then the improved output. I think he was talking about the. I think you're talking about the performance, which is not buckets, it's equity curves. And if you run that, you get to these equity curves here, which you can download here, and you'll get the same 5 buckets, but you'll see how they performed over time rather than annualized. We will be emailing you the slides, those will be available to you, and the entire webinar will be available as well. on our website and on YouTube. Any other questions? Okay, when to use screening, which rules should go into screens, and when to use ranking, or is it best to combine both? That's going to be the first topic I'm going to talk about in my next webinar. When to use screens, when to use universes, and when to use ranking systems. That's going to be the major subject of my next webinar. But in short, I would put as many factors as you can into ranking. And I'll explain why in 2 weeks. And June 9th is the next webinar. And please sign up.